Today, I'm breaking down the 5 best Fidelity index funds to buy and hold forever. All of them stand out as reliable, low cost, and built for the long run. I'm gonna walk you through each of them one by one so you'll know exactly how they fit together into a portfolio that can last a lifetime. Stick with me until the end. I'm gonna explain one Fidelity fund I don't recommend, and I'll briefly address the zero fee funds that you might have heard about. But first, let's start with the fund that serves as the foundation for countless investors. The Fidelity 500 Index Fund is Fidelity's version of the S&P 500. It holds the 500 largest companies in the United States measured by market capitalization, which is simply the total number of shares multiplied by the stock price. Why does this matter? Because those 500 companies represent about 80% of the entire US stock market's value. When they move, the market moves. Apple, Microsoft, Amazon, Alphabet, Berkshire Hathaway, Johnson & Johnson, you're automatically invested in the biggest names that drive the US economy. Performance over time has been strong. Over the past 10 years, this fund has averaged about 12% annually. Of course, returns vary year to year, but that's what history shows over a full decade. The expense ratio is practically zero, at 0.015% per year. That means for every $1,000 you invest, you're paying about 15 cents in annual fees. And fees definitely matter because over decades, even small costs eat into your total return. But it's not all upside. Let's be honest. If you invest, you'll experience downturns. During the financial crisis in 2008, the S&P 500 fell by more than 50%. It took over 3 years to recover, and in the dot-com crash of 2000, the drop was about 45%, and it took more than 4 years to get back to even. More recently, in 2020, the index dropped about 30%, but recovered in just a few months. That kind of quick rebound isn't typical, and you shouldn't expect it every time. This fund is best for investors who want to match the performance of America's largest companies. It leans slightly toward growth stocks, particularly in the technology sector, which makes up close to 30% of the holdings. That concentration can create volatility, but it also reflects where much of the growth in the US economy has come from. So if you're looking for a single core US fund to anchor your portfolio, FXAIX is a great place to start. But if you want exposure not just to the largest 500, but to the entire US stock market, then you'll want to look at the next fund. The Fidelity Total Market Index Fund, ticker symbol FSKAX, goes beyond the S&P 500. It holds more than 4,000 companies, from the largest household names to mid-sized firms and even smaller companies that many people have never heard of. So what that means is simple. When you invest, you're buying into the entire US economy. Large caps, mid caps, and small caps. Everything is included. But you also get exposure to firms that may grow faster over the long term. Over the past 10 years, FSKAX has returned about 11 to 12% annually. Fees are identical to FXAIX at 0.015%. The sector breakdown is also similar, with technology leading, followed by healthcare, financials, and consumer discretionary. But the key difference is diversification. That means less concentration risk and more spread across thousands of businesses. So which one should you choose? FXAIX or FSKAX? It really just depends on your preference. If you want simplicity and don't mind focusing only on the largest 500, FXAIX works. If you want everything, the giants plus thousands of smaller players, FSKAX gives you the total market in a single fund. The US is powerful, but it's not the whole world. That's why the next fund opens the door to international markets. The Fidelity Total International Index Fund, ticker symbol is FTIHX, is designed to capture everything outside the United States. It holds more than 5,000 companies across developed and emerging markets, tracking the MSCI All Country World Index, excluding the US. That means you're getting exposure to Europe, Asia, Latin America, and much more. Companies like Nestle, Toyota, Samsung, Novartis, they're all included. Together, international markets account for more than half of global economic activity. Ignoring them means leaving a large part of the world outside of your portfolio. Performance has lagged behind US stocks in recent years. Over the past 5 years, FTIHX has averaged about 5 to 6% annually. That's less than FXAIX and FSKAX, but that's exactly why diversification matters. If US stocks go through a period of underperformance, international holdings can help balance the picture. The cost is still extremely low at 0.06% per year. That's 60 cents for every $1,000 invested. The diversification is also much broader. In this fund, the top 10 holdings make up less than 10% of the portfolio, compared to nearly 30% in the United States funds. That means your money is spread across thousands of businesses in dozens of countries. International investing does bring risks, currency fluctuations, political events, different regulations, but it also also spreads your exposure across multiple economies. Over decades, having that global reach reduces your reliance on just one country. So if you're serious about building a portfolio that lasts a lifetime, pairing a US index fund with FTIHX gives you both domestic and international exposure. But there is another piece that you shouldn't ignore, and that's bonds. The Fidelity U.S. Bond Index Fund, ticker symbol is FXNAX, provides exposure to the US bond market. It tracks the Bloomberg US Aggregate Bond Index, which includes government bonds, corporate bonds, and mortgage-backed securities. Altogether, it holds more than 8,000 different bonds. Bonds are not exciting. They don't deliver double-digit returns like stocks, but they serve a crucial role in a portfolio. They reduce volatility, provide income, and act as a stabilizer when markets get rough. Over the past 10 years, FXNAX has returned about 1 to 2% annually. That's not impressive, but again, that's not the point. The point is protection. When stocks fall, bonds often hold steadier, giving you balance. The cost is extremely low at 0.025% per year. That's 25 cents for every $1,000 invested. The fund is diversified across US Treasuries, mortgage-backed securities, and corporate bonds. Treasuries are the largest portion, which makes sense because they're considered among the safest investments in the world. And if you're building a simple 3-fund portfolio, US stocks, international stocks, and bonds, like the FXNAX, is the bond fund that fits the bill. And as you get closer to retirement, increasing your allocation to bonds helps to reduce risk. Now, what about real estate? Fidelity does have a real estate index fund, but here's where things get tricky. Fidelity offers the real estate index fund, ticker symbol is FXRNX, but it's not the one that I recommend. The issue comes down to how the fund is managed. Even though it's called an index fund, it doesn't consistently track the underlying index as closely as it should. The turnover rate, which measures how much of the portfolio is bought and sold each year, is unusually high for an index fund, and it creates extra costs that can drag down returns. By comparison, the Vanguard Real Estate ETF, ticker symbol is VNQ, has a turnover rate closer to 7%. That's much more in line with what you want in a passive real estate fund. So if you want real estate exposure in a Fidelity account, I'd suggest buying VNQ instead. I want to quickly address the Fidelity Zero Fee Index Funds, because I know some of you are wondering about them, and for good reason. Fidelity made headlines when it launched index funds with no expense ratios. On the surface, that sounds incredible. Investing for free. But in practice, they aren't as strong as the funds we just covered. The structure and tracking of those zero fee funds aren't as reliable, and they don't have the same long history as all the funds that we just went through. The cost difference between nearly zero and literally zero is pennies, and it's not worth the trade-off. That's why I focus on the established funds that have proven themselves over time. So let's bring this home. The 5 Fidelity funds you can buy and hold forever are the Fidelity 500 Index, the Fidelity Total Market Index Fund, the Fidelity Total International Index Fund, and the Fidelity U.S. Bond Index Fund. And for real estate, skip Fidelity's version and go with Vanguard's VNQ instead. Together, these funds cover the largest U.S. companies, the entire U.S. market, international markets, bonds, and real estate. Low cost, diversified, and designed to last a lifetime. Now, none of this is personal financial advice. I'm definitely not your financial advisor, and this is general education to help you understand your options. Always do your own research or consult a professional before making decisions about your hard-earned money. If this video helped you in any way, make sure to hit that like button, subscribe to the channel, and share it with someone who's building their portfolio. And I would love to know, which of these funds are you already holding and which ones are you considering adding? My name is Chris. As always, thank you guys so much for watching, and I'll see you in the next one.